Hello students, welcome to my channel Stream Commerce. In this video, we are going to study about accounting concepts. Before starting with the accounting concepts, let us first understand about the meaning of accounting concepts. Accounting concepts are the general rules of accounting to be followed and practiced by an accountant while preparing the accounts of a firm. Accounting is the language of business, and this language needs to be consistent for all businesses, else it would be difficult for the various users of financial statement to interpret the accounts of a business. In order to standardize this language, accounting concepts have been developed over the years. Accounting concepts are general guidelines for sound accounting practices. Let us study about the importance of accounting concepts. First is reliable financial statements. The accounting concepts applies to every stage of financial accounting and reporting, from recognizing relevant transaction to recording accounting books until financial statement preparation and disclosure to the different users of financial statements. Second, it is based on GAAP. The accounting concept is based on the guidelines set by GAAP, that is generally accepted accounting principles. It is a systemized process of recording transaction and maintaining account records that helps an accountant save time and efforts. Third, it promotes easy understanding. The accounting concepts promotes an easy understanding of financial information, relevance, reliability and comparability in financial statement preparation and reporting. Now let us study about the objectives of accounting concepts. First objective is to promote a uniform and consistent method, which means that the primary aim of accounting concept is to promote a uniform and consistent method of recording business transaction in time for the preparation of financial statements. Second objective is to serve as a general guide to accountants, which means it serves as a general guide to accountants in recording and maintaining financial documents, because only such is supposed by the concept of recording in the books of accounts. Third objective is to promote uniformity, which means that it promotes uniformity to achieve a standardized manner of financial reporting and to compare financial statements between companies. Now let us study about the accounting concepts. First is business entity concept. This concept basically states that the business is a separate entity from that of its owners and as such is recognized as an artificial person that keeps its own record and transaction. This concept is one of the accounting concepts that states that a business and the owners are two separate entities and therefore should be considered separate from each other. As per this concept, the financial transactions pertaining to the business entity should be recorded separately from the business owner's transaction. This concept is also known as separate entity concept or economic entity concept, which means that the owner of the business and the business itself are considered as two separate entities. Therefore, any transactions or events that impact any other entity apart from the business will be considered as irrelevant and not be entertained. Let us understand this with an example. Let's say, for example, you are the owner of a business and you decide to withdraw money to pay for your children's fee. Such a withdrawal acts as an expense for the business as it allows a loss of capital to fund a personal expense. The transaction must be written as an owner's draw to signify the transaction is for the personal use. It doesn't include any paying yourself a salary, which would be considered regular wages. Now let us move on to the next concept, which is going concern concept. It is one of the accounting principles that states that a business entity will continue running its operation in the foreseeable future and will not be liquidated or forced to discontinue operation for any reason. In simple words, going concern concept means that the entity is viewed as a continuing its business for the upcoming future. It assumes that a business has neither the intention nor the need to close its operation in the near future. Let us understand this with an example. A company manufactures a chemical known as chemical X. Suddenly, the government imposes a restriction on the manufacture, import, export, marketing and sale of this chemical in the country. If chemical X is the only product that the company manufactures, then the company will no longer be a going concern. Next concept is money measurement concept. Money measurement concept is an important accounting concept that is based on the theory that a company should be recording only those transactions that can be measured or expressed in monetary terms on the financial statements. Money measurement concept is also known as measurability concept, which states that during the recording of any financial transaction, those transactions should not be recorded which cannot be expressed in terms of money value. So in simple words, according to this concept, only those transactions which can be measured in terms of money or monetary worth are recorded in the books of accounts. Let's understand this concept with an example. For a company, sale of goods are worth rupees 2 lakh, purchase of raw materials are rupees 1 lakh, rent paid is rupees 10,000, etc. are expressed in terms of money, and so they are recorded in the books of accounts. But the transaction which cannot be expressed in monetary terms are not recorded in the books of accounts. For example, sincerity, loyalty, honesty of employees are not recorded in the books of accounts because these cannot be measured in terms of money, although they do not affect the profit or loss of the business concern. Let's move on to the next concept, which is historical cost concept. This concept states that an asset is recorded at cost at the time of its purchase and its value shall be reduced systematically by charging depreciation, which means that all acquisition of items such as assets or items needed for expending should be recorded and retained in the books at cost. Let us understand this with an example. If a building is purchased for rupees 80 lakhs, it would continue to appear in the books at that figure, which is rupees 80 lakhs, irrespective of its market value. So according to historical cost concept, an asset should be recorded at the cost at which it is purchased, regardless of its market value. Next concept is dual aspect concept. As per double entry accounting, the dual aspect concept indicates that each transaction made by a business impacts the business in two different aspects, which are equal and opposite in nature. The accounting equation used in this concept is assets is equals to liability plus equity. The accounting equation is registered in the balance sheet where the amount of the total assets should be equal to the liabilities and equity of the firm. This concept explains that if something is given, someone will receive it. This can be explained as whenever a transaction occurs, there are two-sided effect. One is debit and the other is credit for a similar amount. For example, Mohan started a business with rupees 5 lakh as a primary investment. This investment done by Mohan will have the following effect on the business. First effect will be, it will increase the asset of the business by rupees 5 lakh. And second effect will be, capital of the business increases by rupees 5 lakh. Let's understand this with another example. Now let's say Mohan needed to purchase some goods for an amount of rupees 1 lakh. Then this will have the following impact on the accounting. First effect will be, purchasing goods increases the asset of the business by rupees 1 lakh, and the second effect will be, it reduces another asset of the business, which is cash is reduced by rupees 1 lakh. Now let us move on to the next concept, which is realization concept. The realization concept or the revenue recognition principle in accounting is a method used by accountants for recording revenue earned by the business. This principle states the time when a business should record revenue in the books of accounting records. This concept is applied in determining the cutoff for the income. It helps in calculating profit or loss for a period under a specific accounting period. Let us understand this with an example. Imagine yourself as an online clothing brand that has received an order of 2 dresses. The buyer is given the option of paying through a credit card or cash on delivery. One way or the other, the order will be delivered and the payment will be received. Now definitely you have to record this transaction in your journal and ledger to include in the financial statement. Thinking like an accountant, you might want to record the revenue from the moment the order has been confirmed, or maybe when the payment is credited, or when the shipment is out, or when the delivery is made. Out of all these approaches, the last one, that is the recording revenue when the goods have been delivered, is the right approach for recording the revenue. It's the point when related risk and reward of the deal have been transferred to the customer. This concept of transferring risk and reward and recording revenue is known as the realization concept. So according to this concept, the revenue should be realized or recorded at the time when the goods or services have been delivered to the purchaser. Here the transaction is being recorded based on the transfer of goods or services from the seller to the buyer and not based on the transfer of risk and reward. This realization principle has been the foundation of the accrual basis of accounting, which presents a similar concept. Now let us move on to the next concept, which is accrual concept. According to this concept, a transaction is recorded at the time it takes place and not at the time when settlement is done. In other words, revenue is recorded and sales are made or services are rendered, and it is irrelevant as to when cash is received against such sales. Similarly, expenses are recorded at the time when they are incurred, and it is irrelevant as to when payment is made in cash for such expenses. Thus, to find out correct profit and to show a true financial position of an enterprise at the end of an accounting period, all expenses and income belonging to that particular period are shown when cash has been paid or received or not. Let us understand this with an example. Goods are sold to Raju on 1st January 2020 on a credit of 3 months. In this instance, a sale will be recorded on 1st January 2020, although the amount will be received on 1st April 2020. Hence, it records the revenue when they are earned and not when they are received in cash, and records expenses when they are incurred and not when they are paid. Next concept is accounting period concept. Accounting period concept is based on the theory that all accounting transactions of a business should be divided into equal time periods, which are referred to as accounting periods. The purpose of such a time period is that financial statement can be prepared and presented to the investors, and also helps in comparing performance of the business with each time period. By preparing financial statements within a particular time period, a company is able to determine the profit and loss that occurred during the period for the business. The lack of proper accounting period will result in variation of results and make it difficult to determine the financial position of the company at that time. Generally, an accounting period is of 12 months. While the time period is fixed, the month can vary from company to company. Let us understand this with an example. ABC company records its transaction from 1st January to 31st December every year and closes its financial statement. Here the accounting period is of 1 year, that is from 1st January to 31st December. However, not all companies need to follow 1 year. Let us understand this with another example. XYZ company records its transaction from 1st January to 30th June every year and closes its books of accounts after that. Here the accounting period is of half year, that is from 1st January to 30th June, and the next period shall be from 1st July to 31st December. Now let us move on to the last accounting concept, which is matching concept. Matching concept states that expenses that are incurred in an accounting period should be matching with the revenue earned during that period. Thus, all expenses for that accounting period, whether or not paid during that year, and all revenue, whether earned or not during that period, should be considered to calculate the profit or loss. It simply implies that revenue and production cost must be calculated during the same accounting period. Thus, the matching principle in accounting says that the income statement of the organization will be reflective of the associated cost of the revenue and the income of that period. Let's understand this with an example. Let's suppose a company produces 100 books for the cost of rupees 4,000. Later, it sells 20 copies of rupees 50 each per unit, thereby getting revenue of rupees 2,000. The matching principle dictates that although the total cost of production was rupees 4,000, the profit would be rupees 1,200 despite the revenue being rupees 2,000. In simple words, in matching principle accounting, the revenue must be considered first for the given period and the one must see the expenses incurred to produce the revenue. Thus here it would be wrong to simply say that the loss of rupees 2000 was incurred since the company invested rupees 4000 in the production of all commodities. That's it for the video. Thanks for watching. If you guys liked my video, then share it with your friends and subscribe to my channel for more videos.